Hello everyone and welcome to Financial Accounting. In this video, we will discuss the reporting of accounting changes and errors, and as usual, look at a couple of examples. Today's video is the first on this topic, and we will concentrate on the changes in accounting principle. There are three areas that require unique reporting provisions: changes in accounting principle, changes in estimates, and correction of errors. Let's first look at the changes in accounting principle. An accounting principle is a general guideline for companies to follow when recording and reporting financial transactions. As stated in the Accounting Standards Code, Topic 250, there are two situations when a change from one generally accepted accounting principle to another generally accepted accounting principle applies. One, when there are two or more generally accepted accounting principles that apply. Two, when the accounting principle formerly used is no longer generally accepted. A change in the method of applying an accounting principle is also considered a change in accounting principle. Can companies change the accounting principles that they adopt for financial reporting? The answer is yes, but they must prove that the newly adopted principle is preferable to the old one. This step is very important because such changes result in the loss of consistency when users of financial statements compare financial statements from period to period. Examples of changes in accounting principle include a change in the method of inventory pricing from FIFO to average cost, or a change in accounting for construction contracts from a percentage of completion to the completed contract method. How should the company recognize a change in accounting principle? This is accomplished by making a retrospective adjustment to the financial statements. Such an adjustment changes the prior year's statements on a basis consistent with the newly adopted principle. The cumulative effect of the change for prior periods is recorded as an adjustment to the beginning retained earnings of the most recent year presented. If a company prepares comparative financial statements, it should restate the prior statements for the effects of the change. Let's look at an example. Carey Company decided to switch from FIFO to weighted average inventory pricing in 2022. Carey Company's income before income tax using the new weighted average method in 2022 is $40,000. Let's see how the calculation of a change in accounting principle is accomplished. In 2020, pre-tax income was $50,000 when the FIFO method was used, and $45,000 when the weighted average method was used. The excess of the FIFO over the weighted average method is $5,000. In 2021, pre-tax income is $40,000 and $37,000 under FIFO and weighted average methods, respectively. The excess of the FIFO over the weighted average method is $3,000. The total amount of excess for 2 years is $8,000. Take a look at this slide. This is how the information Carey Company presented in its comparative income statements, assuming a 30% tax rate. You can see that the income before tax has been restated in the years 2020 and 2021. It is the same as it was in the weighted average method column. Under the retrospective approach, Carey Company reported the prior year's income numbers under the newly adopted method. Therefore, the retrospective approach preserves comparability across years. Note that the amount of the adjustment is shown net of any related income tax effects. I hope you found this video helpful. If you did, please make sure to subscribe, hit the like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.